Okay, let's just dive right into this explainer and completely dismantle the comfortable illusion of standard diversification. When most of us think about risk management, we usually just picture, I don't know, setting a simple stop loss or maybe trimming a position here and there. But honestly, that is barely scratching the surface. Today, we're looking at a complete 5-layer structural framework. And just to be super clear right up front, this isn't financial advice. But we have to talk about this because the hard truth is, the popular version of risk management is exactly why most retail portfolios silently lose half their value during a crash, and people literally never figure out why.
To really get why this happens, we just have to look at the market right now. The Magnificent Seven, you know them. Apple, Microsoft, Nvidia, Google, Amazon, Meta, and Tesla, they make up roughly 30% of the entire S&P 500, almost a third. And that sets up a terrifying structural vulnerability in your portfolio. You might pull up your brokerage app, see a bunch of different tickers, and think, hey, I'm pretty safe. But when such a massive block of the entire market is concentrated in literally just 7 massive tech companies, well, the baseline rules of safety completely change.
And here's where the math gets genuinely terrifying. During a real market drawdown, the correlation of those top tech stocks spikes to roughly 0.9. That means they all move together, almost exactly in sync. So when someone tells you, oh, I'm totally diversified, I own 20 different tech stocks, what they actually own is one single bet. They've just made that exact same bet 20 different ways. When the market really stresses out all those individual tech and AI infrastructure positions, they don't protect each other. They just drag each other down.
So let's get into the framework. Layer 1 is position-level risk and the basics. Now, this is where most retail investors start, and unfortunately, it's usually where they stop. Is it necessary? Absolutely. But it's also kind of the easy part, right? It's just managing risk at the surface level of a single stock on your screen.
There are basically 2 hard rules here at Layer 1. First, you've got to cap any single name at a strict 15% ceiling. This isn't just some soft, nice-to-have guideline. It's actually based on Harry Markowitz's math from way back in 1959. It acts as a mathematical guardrail so you don't put all your eggs in 3 shiny baskets that look amazing on paper but could absolutely obliterate you in real life. Second is the negative 30% forced review trigger. If a position drops 30% from your entry, you don't necessarily automatically sell, but you force a conversation. You sit down, completely objectively, and ask yourself, did the thesis actually break, or did the price just move? You make that call before emotion takes over the steering wheel.
All right, let's move right along to Layer 2, which is correlation risk. This builds into the exact area where that comfortable illusion of safety just totally shatters. If Layer 1 was about individual stocks, Layer 2 is about how those stocks actually interact with each other. See, a portfolio is not diversified simply because it happens to have 20 names in it. It's only diversified when those names actually behave differently from each other when market conditions flip.
Cliff Asness perfectly captures the problem here. He says, hoping your assets will diversify when you need them to isn't a risk management strategy, it's a prayer. I absolutely love that quote. Adding more semiconductors to an AI-heavy portfolio to diversify is basically like praying for rain while you're standing in a flood. During a stress event, 20 tech stocks have an average pairwise correlation north of 0.8. Throw in some semiconductors and you're hitting 0.9. You might feel diversified, but mathematically speaking, you absolutely aren't. So the absolute crucial point here is that true diversification requires holding assets that are structurally in opposing trades. The fix isn't to just swear off tech entirely. No way. The fix is to require that some portion of your portfolio is structurally operating on entirely different mechanics. For instance, a defense contractor and a semiconductor stock. Those are in different trades. A pipeline operator and a software firm. Again, structurally very different trades. That is the kind of balance we're looking for.
If you look under the hood of your portfolio, and the average correlation across your entire book is above 0.6, well, your second layer is broken. And listen, the absolute worst time to find out your correlation is way too high is right in the middle of a market crash, when everything is already trending towards 0. Now we move to Layer 3, which is cross-asset hedging. This turns that correlation warning from Layer 2 into a very active defensive tool. We're essentially moving from passively crossing our fingers and hoping things don't crash together to actively buying things that react opposite to each other. This perfectly illustrates the 2 main pairs you need doing the heavy lifting. Let's take a quick look. First up, the inflation hedge. That's gold and energy. Both of these tend to rally when the dollar's purchasing power comes into question, and they behave very, very differently from a NASDAQ-heavy book. Second, we have the geopolitical hedge, defense and infrastructure intelligence. When geopolitics inevitably drops a bomb on the markets, companies whose revenue actually increases when the world gets a little dangerous, they absorb that hit for you. Tesla and a tank manufacturer are basically in totally opposite trades.
But you have to remember something really important here. This allocation isn't a yield strategy, it's an insurance policy. A 5 to 10% allocation to these pairs is honestly supposed to look completely stupid 11 months out of the 12. And that's a feature, not a bug. The premium you pay is the upside you give up when tech stocks are ripping. But the payoff? The payoff is the position you still have left when they aren't.
Moving right along, we have Layer 4, the capital floor. Now, I'll be honest, this one is deeply unpopular with retail investors because it requires you to intentionally hold a genuinely boring floor of capital. Every portfolio needs a floor, but human nature just makes us hate looking at boring, slow numbers when the rest of the market is flying high.
This floor basically consists of two pieces. First, you've got inflation-linked bonds, like US I-bonds, that aren't trying to chase crazy yields. They just sit there safely, matching inflation plus a little fixed margin. Second, a Warren Buffett-style cash holding. Now this floor is inherently going to look like it's dragging your portfolio down during a raging bull market. But remember, it's completely uncorrelated with absolutely everything you own in your equity book.
I know it is incredibly tempting to just cut this floor when the market is flying, right? But you cannot cut it. The most common mistake people make is looking at this cash and bond floor during a massive bull run, deciding it's dragging them down and dumping it all back into equities. But as Vanguard's research proves, this floor's sole job is preservation. It's literally the only part of your portfolio that gains buying power when everything else loses it. If you cut it, where's your dry powder going to come from to buy the dip when everything else collapses?
And finally, we arrive at Layer 5, tail risk rehearsal. This is the final step that almost nobody does. And it's not because it's super hard, but because it forces you to face some highly uncomfortable mathematical realities. Institutional investors call this stress testing, and they do it every single quarter. Retail investors? Well, they almost never do it. You really need to take these 4 specific scenarios right now. A Taiwan Strait flare-up, an expansion of the Iran conflict, a 2027 US recession, and an AI capex bubble unwinding. You must literally paper trade, meaning, simulate the math without using real money, these specific tail risk scenarios, just to see if your portfolio actually survives the resulting drawdown. If things go sideways with Taiwan, semiconductor revenue assumptions break, defense spikes, energy spikes, you have to honestly ask yourself, what does each line in your portfolio actually do in that moment? Pre-playing these scenarios even once is super uncomfortable, because it completely forces you to admit which of your positions are fundamentally fragile before the crash even happens. And once you admit it, well, you actually have to do something about it. Rehearsing is inevitably going to force you to adjust at least 1 or 2 position sizes. And frankly, making that adjustment, that is the entire return on investment for actually doing Layer 5. Okay, before we wrap this explainer up, we need to have an honest reality check about active versus passive investing. Because everything we just covered assumes you actually want to actively manage your money, but we really need to look at what historically happens when you try to do that. The numbers are pretty stark here. The S&P 500's long-term historical return is around 10% annualized. And that 10% is for the passive investor, the person who just blindly buys a low-cost total market index fund every 2 weeks and literally ignores their account for 30 years. Yet, according to Dalbar's well-known studies, the average active retail investor captures a drastically lower return. We're talking only about 6%. Think about that for a second. You do all that extra work, you take on all that stress, just to lose 4% a year? It is a massive margin of underperformance. And this massive performance gap, it's almost entirely driven by behavior. It's panic selling at the absolute bottom, it's chasing the tops, and it's falling victim to the disposition effect, which Kahneman and Tversky brilliantly identified way back in 1979. It's basically this deeply ingrained human tendency to sell your winning investments way too early while stubbornly holding on to your losing investments for far too long. It's not that we aren't smart, it's just deeply ingrained human psychology messing with us.
So here is the real reality check. If you're honest with yourself, and you know deep down you're going to panic sell when the market drops, the ultimate risk management strategy is beautifully boring. It's just 3 words: index, automate, ignore. Just buy a broad fund, set up your auto deposits, and go take a nap on a beach somewhere.
But if you choose not to do that, if you insist on running an active portfolio with 20 names and targeted allocations, then you must implement all 5 of these layers: position size caps, managing opposing correlations, building out cross-asset hedges,
maintaining a boring capital floor, and actually rehearsing your tail risks. These aren't just optional suggestions, they are the literal price of entry. Because your risk management system is only as protected as its weakest link. If your capital floor is too thin, the other layers simply do not matter.
So I want you to be completely honest with yourself. Which of these 5 layers is the absolute weakest in your current portfolio right now? The very first step to fixing it is naming it, so let me know in the comments below. And hey, if this explainer changed how you view diversification and risk, make sure to hit subscribe for more. Build your layers, test them while the market is quiet, and let the system absorb the hit. Thanks so much for joining me on this explainer.